This is part 2 of a 3-part series with Khaled Talhouni, managing partner at Nuwa Capital, an early-stage MENA VC with over 30 startups in their portfolio. In this part, Khaled shares actionable tips and best practices for raising your first round, covering topics like creating FOMO, approaching VCs effectively, and what it takes to really stand out. Make sure to subscribe so you don't miss the final part, where Khaled reflects on the key lessons from 15 years in venture capital. So, first question is, how do I know that I'm ready to raise as a founder?
I mean, founders are always raising, right? Like, I don't think founders ever stop raising, but even at the very...
Sorry, I meant first time. How do I know I'm ready?
I think you need to, I mean, your first round is usually like family and friends and maybe some angels. And that's, I mean, they're really backing you around a broad concept. So at that very first raise from family, friends, angels, etc., I think you need to have just kind of broadly identified the problem. Between that raise and the pre-seed or seed or whatever you want to call it, I think then you need to start articulating, okay, this is the problem set. I want to solve it. And then you have to have a bit more detail on your vision for solving it and how you're going to reach product market fit and your path towards monetization. You don't have to monetize it. You have to have a view to how you're going to do it, a view on your business model, a view on your product, how it all comes together. I think once you are able to articulate some of these kind of key concepts, then I think you can go talk to investors. I think that's the first step. You need to have, maybe to kind of rehash them. It's like a great understanding of the problem set, how you're going to solve it, or the early idea of how you're going to solve it, your product roadmap, what the product will look like, how you'll monetize it, and why this is a huge market. And you're able to win. You have the right to win in it.
And let's assume we got friends and family around. How do I apply now to a proper VC? When is the right time to apply for a VC for my first ticket? And also, what are the criteria? Like, what do you think are the criteria?
I think it's that, like what I mentioned, I think because it depends on the VC also. Some VCs love early. We like early a lot. So we do very, very early.
I'm talking early.
So if we like the founder, we'll come in at idea stage even.
Okay, even idea stage. I didn't know that.
I think you really want to match it to the founder, the VC has to understand, the founder needs to understand what stages the VC does, and different VCs do different things. So we'll do idea stage on strength of founder. Won't do many, but we do it we do go as early as that. Different VCs calibrate for different things. Some only do post-product market fit. Once you know that if you inject capital, the product works and it has a market that it can go to. Others do much later, once you're at unit economics positive. So Series B or Series A, even depends on the business. So I think it really depends on the VC itself. Different VCs approach it differently. Ours is as early as the founder idea. So just based on the founder and the idea stage through to all the things I just mentioned.
And what's your advice? How should I apply as a founder then? Do I just go to your website, apply? Do I get an intro? Tell me, give me your best advice as a founder.
Best way to get attention is get a solicited intro. I mean, get someone to introduce you.
Anyone?
I mean, preferably someone who knows the VC reasonably well.
Preferably a founder you backed. I guess.
That's the best one. That's the best one. But it doesn't have to be. But I think it has to be someone someone from the ecosystem that has cachet, that has has been, it could be a founder, could be somebody else. But I think that's the best way to do it.
Okay, clear. Second best.
Through industry. If you know someone who knows someone in the industry, that, VC will also kind of look at. I think solicited intros generally are the best possible way. I think the worst way is cold inbound, just because we get so much like that. It's hard to prioritize. And then through other VCs is the other one, if you're able to do that.
Through other VCs as well. Nice.
We'll say no to a company, but if we think it's a good fit for another investor, we'll make the introduction.
Let's say I applied, I just wasn't right. The time wasn't right. The time wasn't right. Not just an excuse. How should I engage after that? How often? How should I be pushy? Should I be pushy? Should I not?
Yeah, I think I love people who do these kind of put us on newsletters, update newsletters. Because there are sometimes when we're not convinced of something, but we may come back later. And that's happens all the time with all kinds of VCs that they, on this first cut, not for us, but on the second cut might be. So I think one is these kind of newsletters. I like them. I read them, I enjoy them. They're getting update. And then at each round kind of coming back and saying, oh, we're looking to raise again. This is what's happened. But I think these kind of passive updates that are putting people on their kind of general update newsletter, I think that's super useful. Assuming the newsletter has some real information in it. The other thing is, if we like a company, but we said no to genuinely because we don't feel like there's a good fit, we will do the opposite. We'll go back out in a year and see what's happened with them. So it's kind of both ways.
How can I make you chase me as a founder? Does it happen? Did it happen to you? Did you ever chase?
All the time. FOMO, create FOMO.
Create FOMO, like action. What's the recipe to create FOMO?
If there's a general consensus, and it happens a lot, that this is a good company, sensing that somebody is going to take your allocation is a great motivator. But that presupposes it's a great company. So you cannot manufacture. That's impossible to manufacture. So, and the definition of great company is fluid and can change over time, but meaning could be, right sector, right entry point valuation, right founder, right, so all of this has to be correct. So to get people to chase.
And did it happen to you? Do you have any deals like that?
Yeah, many, all the time.
Nice.
All the time. All the time. And that doesn't mean it ends up being a great company in the end.
Anything you want to mention here? Like any story,
I remember in the past, Kareem was a very, very hot deal. And people want to come in. So there was a lot of, pushing and shoving around who's going to come in. We invested in HomeSmart. There was a bit of that. Iowa, also a little bit of that. Calo, which is our delivery business. Some of the newer companies we invested in that we haven't announced, there was a bit of that as well. I mean, I think it tends to be more common than you think.
So VCs, so for listeners, VCs sometimes also go and check out founders and then reach out in case they're interested.
Yeah.
I think you covered before, in case we didn't go just into the details. How long does it typically take? How much should I budget in terms of time from starting, raising from a VC, from early stage VC to be specific, to closing the round on average? So,
I mean, and again, we're trying to get better at this. I think we're getting better. It should early stage, seed, pre-seed, seed, and post-seed. This should be a month-long process, max.
Entire thing. From hi to we like you.
It should be. Later stages can take more. And, we've done it in as short as a week to as long as 3 months, 4 months.
Okay.
But I think pre-seed, seed, post-seed should be pretty clear within a couple of weeks that you're going to do it. And then it just becomes a bit about kind of finalizing and stuff like that. I think sometimes some investors spend too much time navel gazing, but you can actually answer the questions quickly and upfront at the early stage because there's not that much to due diligence in the business. The later you go on, it can, Series A is different, Series B is different. Beyond that, it's different. Then you're really looking at details and cohorts and you're looking at you've got some meaty stuff, meaty data to look at. But before that, you're kind of fooling yourself that there's a lot of things to look at. No, I think what will be time consuming for the pre-seed seed is understanding the industry quickly, reference checking the founders, the team, but also reference checking the industry, and people in the sector and understanding the model. I think that's what takes more time than anything. And on the founder side, what is something that can help them not take 3 months, take a month? Is there anything they should do? Maybe things to prepare in advance, etc. Well, I think back to your earlier question, I think having all your ducks in a row, your documents ready, if it says pre-seed, seed is probably have the safe ready to go. I don't want to say data room, but because it's early, but the equivalent of all your stuff good to go. I think we always look, and I don't know if other VCs do this, I'm sure they do, have, your 4 or 5 customer reference checks ready to go. Say, you can meet these 4 customers. Can meet these guys. This is who I think you should talk to. Just having stuff ready, information ready is useful. Later stage more so. So at later stage, if you have your data room, all of that stuff in a row, you have an FAQ, a DDQ, all of that stuff is super useful. Early stage, there's not so much you can prepare for, but being ready is, I think, a really important thing. What makes a really good pitch deck in general, early stage again? It should be very clear what you're trying to do from, slide 1. You'd be surprised how much sometimes you see decks. It's you're on the 10th slide. And it's what are you doing? What does this business do exactly? Do you know what I mean? So I think being concise and to the point and clear. Yes. That's number 1. So less pages, the better, if you can. Less pages, the better. Yeah. And just to the point, this is the team. This is the problem. This is how we're solving it. This is the team. This is what product looks like. This is the business model. This is our traction so far. This is the addressable market. This is the revenue model, business, whatever. That, 10 slides, hit, good. Maximum 20, I think is good. But if you spend 15 slides explaining the industry, I think that's no good. So kind of each slide should have also serve a very clear purpose. Literally, if it exists, it should answer one thing very clearly, move on, next. Exactly. Do you have any most memorable, what's your most memorable deck? Did you see any deck that's
yeah, these guys really get it. Like it was so simple, so nice, so easy to understand.
Yeah, it's not so much the decks; it's the call or the meeting. Deck is very secondary. Yeah, it's just about how you present, and we know what I just mentioned about being clear, etc. I think that's the way to do it. I'm always reminded by the Iowa founders, Anas and Mahdi. There, I met them for the first time, maybe 5 years ago now. It was super clear. We think there's a big gap in optical at this price point for this quality. You either have luxury or you have fragmented lower entry point, lower price point.
Mhm.
We think we can do it. We'll start by selling third-party marketplace. Then we're going to do private label. Then we're going to probably do offline retail at one point. And this is why it's going to work. These are the margins, blah, blah. It's like, okay, done. Like, great. Like, I think that's very, very memorable. There's some that just grab you on traction. So the first time I had an initial call with the Calo founder, Ahmed, it was solicited intro, I remember. And I was like, I kind of glanced over the deck and I wasn't so keen. I didn't really get the food meal prep thing, like subscription thing. I was like, this is really for us. And then Ahmed just kind of lit the call on fire, right? Like, and then he said, yeah. And this is how much we've been growing in the past 6 months since we started in Bahrain. And I was like, wow. So sometimes traction speaks for itself.
Yeah.
And that, the traction speaks for itself in the sense that it throws out your lazy assumptions. It kind of negates them and makes you sit up and be attentive, like to what's going on.
Like if you want to tell, like, I don't know, plenty of founders around us, is this the best kind of practical advice, which is if you can prove it, if you can show traction, like just go for it. Don't waste time on other things. Just prove it, try to get traction. It gets easier to raise.
Nothing better than just proving it, or just having a real command of your industry. I remember like when we invested in Muwazana, which is kind of like a market maker. It's an unusual business. It's kind of capital markets, infrastructure business for Saudi. And, the guys, we'd known them before, but then they had such command of the industry. And then we brought in a couple of people to talk to them who are of that industry. And you could see they were going, because we don't understand that in depth. You could see that they had such command of the subject matter, just like, done. So real deep knowledge of the industry, the problem and the solution. I keep coming back to the same kind of theme, but like demonstrating that it makes it kind of a great investment.
Any common mistakes founders do at this stage when they are raising goals?
Over optimizing for valuation. I think people are sometimes over obsessed with just getting a slightly bit more valuation. I mean, valuation matters and your dilution matters, but ultimately you want to make sure that you're raising the right amount, not too much, for what you need at this stage. If you push your valuation too high early on, it makes the next round much harder because you need to grow into it. The more you push it higher, the earlier, meaning the earlier the stage of the company, and relative to that stage, you're able to kind of raise at a higher valuation, the harder it is that you'll be able to raise the next one. There are so many companies that I've lived through that have, optimized for, one of the rounds, round one, round two, seed to pre, whatever. And, they're able to raise a large amount of capital and at a high valuation relative. And they do okay. They don't smash it out the park, but they've done reasonably well. The next round becomes super hard because you've just not, someone has given you the benefit of the doubt, has basically loaned you your future valuation today, so basically, and you have to be able to pay it back through your performance. If you do well, but it's not up to that accrued interest, do you see what I mean?
Yeah.
Then you're in trouble.
Yeah.
Also, I think, sometimes with higher valuations, you raise more, and sometimes more often than not, when you raise more than you need, especially early on, you become less frugal and you become less effective.
Yeah.
And you become a bit, without even thinking, it's just a subconscious human, like psychology thing. You just become profligate,
On that note, like, is it a general rule of thumb, raise as much as need or a bit less? Like, just not more?
Yeah.
You shouldn't raise more. There's no reason to raise more. There's never a good reason to raise more.
I'll give you an example. The best company I ever invested in is a company called Jawakir. They raised once and only once, $500,000 one time at the very beginning, at that inception, a little bit beyond the inception stage. There was an earn-out, so the exit's a bit complicated. I think the exit was about 250 million, but raised one-time dilution of 500K. And I'd love to see more of those types of companies.
Can they share more, or can you share more now or later? Like what makes them special? Efficiency?
Oh, Jawakir, like very clear efficiency and eye on profitability from day one.
So it's a mindset. It's not like rocket science. It's just like, what makes them special, really? Is it the business model? Is it what?
I mean, this is an extreme case because they had like a very clear product market fit. The operating costs were low, ultra high margins, virality. There's just so much going on with it. It was an online card gaming business, Arabic card games. Very simple. Yeah. But I think that it all came together very nicely. But first and foremost, you give like tons of credits to the founder, Muhammad, and Yusuf, and the rest, and there were other kind of co-founders. That, that's an intense focus on being frugal, being effective, efficient, and just growing step by step. Took a long time, but, clear-eyed on how to make it work.
And what are the most important points for founders to understand in their term sheets, especially in the first time? Again,
I mean, the usual first rounds, like the safes, are pretty straightforward. I think one thing to understand is that it can be a little bit trendy to do these, what we call a nested safe. So basically, you come to us, to Nuwa, and, you say, okay, I'm raising $500,000 at a 5 million post-money cap. Mm-hmm. And we say, okay, great. And then you get a little bit more traction. 3 months, you raise another 300K at an 8 million cap. And then you raise, and on and on and on. So you never have to do a clear equity round. But then you've accumulated all these kind of safe notes on top of each other, and they're all post-money safes. And so that means they disproportionately only dilute you. So without even thinking, you've kind of built all of these on top of each other, and then you get into a little bit of trouble.
Okay. Any other tip?
You don't see it as much anymore, but this sort of predatory term sheets, too much equity, too much, but they're rare now. I mean, you don't see that anymore. Or someone wants to take 50% of the company, or like wants to have all these controls. But it's rare. I think the market has evolved beyond that. I think
there's more competition, to be honest. There's more competition.
Yeah.
10 years ago, there was 2 VCs or 3,
Yeah.
Is there anything founders should avoid completely when negotiating their term sheets? Like something they really shouldn't fall into the trap? Like probably something you were just...
Yeah, I think, like I said, there's more of a market. Like you said it best, Yanni. I think there's a marketplace of capital now. So it's not just take it or leave it and just something going to get snuck in there. I mean, there are a lot of standardization of term sheets and safe notes and convertibles to make it much more normal process. And less of that stuff going on,
And final question in this segment: what are some misconceptions that also founders could have raising? You see them, and sometimes maybe you see things you haven't expected. Misconceptions they had.
This is rare, but not that often. I think the mindset sometimes is that they come to investors saying, "You owe me money," almost because I'm an entrepreneur, and like an entrepreneur is something like. Our job is just to push money there. And I think that the attitude can be a little bit off-putting. I can understand why founders can get very, very frustrated with investors, and I don't blame them. But I think it's not a fit for everyone, right? Like it's not your company is not a fit for everyone, and that's okay. There's a marketplace of capital, as we said. You can go and find capital elsewhere. Don't owe people capital, and I think sometimes people don't get that. Especially, and this will get me into trouble. Like people who have an impact focus, like someone has an impact or ESG focus or something like that. Like no, but you need to support entrepreneurs. I mean, yes, that's.
But I have LPs. Yes, but I have LPs.
Yeah, I have to invest in stuff that I think will make a return, right? Like that's the model, right? There's a sense that investing is altruism, kind of form of philanthropy, which it isn't, right? It really is not. So trying to say that diplomatically, but yes, yeah.
Like if it's a no, it's a no. We have our reasons. That's definitely one thing.
And don't get me wrong, I think a lot of VCs can be quite dismissive and negative, and I get it. I totally get it. But I think sometimes there's the 10-20% of founders, not more than that have this misconception that, we're here to kind of just support. And no, we're not here to support. I'm here to make money. I think remember that I am here to make money, as you should be also here to make money.
Hopefully.
And that's the point of this whole thing, right? Otherwise, what are we doing, right? Like we're here to kind of build businesses that make money, ultimately.
Yep. Alright, that's it for part 2. In part 3, Khaled will share key lessons from 15 years in venture capital that founders and investors can learn from. Make sure you subscribe so you don't miss it. See you soon.